In this video, I'm going to update my ISA portfolio performance. It's been quite a ride over the last couple of weeks, and there's been another boost to its value. However, I expect some storm clouds ahead. So I will cover what I intend to do in the near future and how those upcoming changes that I'm expecting will influence my investment strategy. Before we dig into how the ISAs have performed, I wanted to go into the main factors and events that have impacted the results recently. Why don't we start with a quick look at the US and UK markets. So looking at the S&P 500, in the last 6 months it rose a non-too-tardy amount, almost 8%, much of that earlier in the year. Things remain pretty flat over the last month or so, but with some major gains over the last few days compensating for that relatively lackluster December period. And it's not a dissimilar story for the FTSE 100. It increased over the last 6 months, a more modest 4.12%, much of that coming in the last few days, with an increase in the last 5 days of over 4%. So far 2025 has been good for both the US and the UK markets overall, and we've seen considerable uplifts in the returns. And I'll cover some of the main drivers for these increases in a moment, as well as my thoughts on any insurance that you might want to put in place, and certainly what I've put in place, just in case some of those market trends reverse. More broadly, what does this all mean to the value of the ISAs? Well, they do continue to grow. My ISA is now hitting almost £280,000. That's a combination of the ISA I've got across a number of different platforms. If I also include my daughter's junior ISA and my partner's ISA, we have close to £350,000 sheltered in ISAs. And those values are testament not only to the excellent returns we've received from the markets, but also the power of consistent investing, staying committed to a long-term goal, even during periods of market uncertainty. So before I dive into the portfolios, let's take a quick look at what's been happening in the markets. Let's begin with the UK. So the UK economy stagnated in the third quarter of 2024, with revised figures showing pretty much no growth. Also, the CBI warned the Chancellor that the UK's economy is heading for, and quote, headed for the worst of all worlds, due to a combination of stagnant growth and potential policy changes. So this has raised some real concerns about the economic outlook. That said, inflation did ease slightly, with a minor drop to 2.5% in December from 2.6% in November. This was a lower position than the market expected, so it was welcomed. This decrease could potentially accelerate the Bank of England's timeline for rate cuts, maybe even as early as February. Also, a little bit more gloom, in part due to the concerns about the high government debt and the ability to service that debt. There was a sharp increase in long-term gilt prices. You can see it on the graph that I'm showing. It shows a 10-year yield and how this compares to the rather disastrous Liz Truss budget outcomes. Now on to the US. So the US market has shown considerable resilience against a number of challenges. There are concerns, of course, and they linger around the potential policy changes that will come under Trump. Strong corporate earnings, reduced inflation, they've both supported the markets considerably. More specifically, inflation did cool, it reduced, but concerns still remain. So December saw a reduction in the core CPI. It aged from 3.2 down from 3.3. This, of course, may give the Fed more room to maneuver in respect of interest rates. However, inflation does remain above the Fed's target, and so it's expected that interest rates will stay elevated for an extended period. In addition, job growth remains really strong, 256,000 jobs added in December, and an employment rate that's dropped to 4.1%. This strong labour market, again, could increase consumer spending and so support economic growth. If you look at the bond market, as mentioned above, like most jurisdictions, the US bond market experienced some volatility due to concerns about higher inflation and the Treasury potentially having to issue more bonds. The yield on 10-year Treasury notes rose to 4.62 in January, and that reflected these concerns. If we turn our attention more globally beyond the US and the UK, there's several trends that have influenced the global markets. If we look at the Eurozone, it's experiencing sort of mixed recovery, with growth varying across countries. Germany, Europe's largest economy, has experienced a contraction for the second consecutive year, really raising concerns around the overall health of the Eurozone. Then, of course, there's political uncertainty. the tariffs that Trump may bring in and US protectionism, it could weigh on investor sentiment. Look at Japan and their monetary policy. The Bank of Japan have signaled a potential shift in its policy. Officials have hinted more that interest rates might increase, and that'll have implications on global bond yields and currency markets. And if we look at the emerging markets, again, it's a mixed picture. China's economy showed some signs of recovery in December, new house prices stabilizing. Could have a positive impact on the growth, on global growth, and that would therefore have a positive impact on things like all important commodity prices. The key trend I'm keeping an eye on with all this information is the divergent economic positions across the different countries. The US is showing real resilience while the UK and parts of Europe are facing real challenges. This divergence, this difference, could have significant implications on my investment strategy and my asset allocation. So I'm considering that as I go forward. But even more pressing than that, in my view, and one of the main concerns impacting the markets and the sentiment is the significant policy changes that may be brought in by the new Trump administration. Recently inaugurated, President Trump's proposed aggressive tariffs on imports from various countries, including China, Mexico, Canada. And these proposals have raised a lot of concerns about potential trade wars and their impact on global growth. There's a real concern that those increased tariffs could lead to higher consumer prices, lower profit margins, and therefore lower economic growth, especially with industries exposed to international trade such as manufacturing and retail. They could be particularly vulnerable and see those negative side effects. If we look more broadly at what the analysts are saying about the economy and the markets, BlackRock suggests that the US equity gains will cool from their highs of 2024, but still stay strong, while the US Treasury yields will climb. They also highlight potential increases in volatility. JP Morgan expect the US economy to continue with a soft landing, moderate job gains, and inflation falling to the Fed's target. They believe that there are attractive opportunities outside of the large stocks which should support the broader equity market performance. More broadly, this is a suggestion that there is going to be a real importance in monitoring US consumer spending, as it's been a key driver of economic growth. There are concerns that a stubborn higher interest rate and potential policy changes could influence consumer confidence and therefore spending. So to summarize, we're facing quite a complex picture. Politically and economically, there's a number of factors that come into play. The US market's shown resilience. There's concerns that remain around inflation and interest rates and potential policy changes coming under the Trump administration. In the UK, it faces its challenges related to slowing growth, and globally, China's economic recovery and potentially some changes in Japan's monetary policy are trends to watch. So going back to President Trump's proposed tariffs, it adds another layer of complexity to the market outlook. Investors will watch this closely. They'll monitor how it's implemented, what policies are changed, and their potential impact for growth and for global trade. Now let's get to the more exciting part, the portfolio and how it's performed. Overall, I'm really pleased with the progress. The current value of my ISA portfolio is around £280,000. That's an increase of just under £10,000 in a month. And of course, that is all tax-free. This is mainly due to that globally diversified portfolio I have, and largely driven by the US increases and, of course, the incredible returns we're getting from tech stocks within the wider portfolio. So let's break down my portfolio and take a closer look at some of the individual holdings. Here you can see Fidelity World Index P. It continues to be an excellent performer. I really like this fund, with a return of 21% over the last year and a return over the last 5 years of 83%. It's got a low ongoing charge of 0.12 and it tracks the MSCI World Index. So incredible returns from the Fidelity World Index P. But how long can this party last? Well, no one knows for sure. But if you look at what a number of the analysts are saying, they've got real concerns around the US market being overpriced and over-concentrated. many analysts are predicting a lower return in the future. But of course, analysts got it wrong many times before. But as insurance against market dips, I'm going to continue to hold more in cash than I normally would. I'd usually hold about 3 years worth of cash as part of bucket one, which is my 3-bucket strategy. But I've recently increased this to just over 4 years, part of which I hold in money market funds, which you can see here. But if you want to know a bit more about my 3-bucket strategy, then I've linked to a video above. As I say, this is why I hold the Vanguard Money Market Fund. It's a very small part of my ISAs and a small part of my bucket one assets. Moving on to Trading 212, I covered in the last update why I invest in the 2 ETFs, the Vanguard FTSE Developed World and the Vanguard FTSE Emerging Markets ETFs. But if you want to know a bit more, you can see that mentioned in the video above and explains the strategy. Since investing with Trading 212, where I put £20,000 at the beginning of the tax year, I've received an almost £3,000 return, which is an increase of around 15%. Now moving over to Vanguard, we also have funds in ISAs, both a junior ISA for my daughter, but also an ISA for my partner. They're very much set and forget, both invested in the Vanguard FTSE All Cap. I invested for my daughter into a junior ISA just before the tax year, £9,000, and just after, £9,000, totaling £18,000. And it's now worth £20,703, so that's an increase of £2,700. Considering my partner's ISA, she also invests with Vanguard in the Vanguard FTSE All Cap. I invested £18,000 just before the tax year, £20,000 just after, £38,000 in total. Her ISA is now worth £44,274, so an increase of around £6,200. So if we look at all of those ISAs combined as a family, we've got around £350,000 invested. So what are my next steps considering the markets and our current investment profile? Well, I'm very comfortable with the funds that we're invested in currently. I'm going to keep a very close eye on the markets and also check the thresholds to see if there's any rebalancing required in Trading 212. In addition, now I have more invested in cash, I can weather some of that volatility I expect over the next 4 years. And it also, if the markets do dip, it gives me some dry powder to invest. Also, we're fast heading towards a new tax year, so I'll ensure that I bed an ISA and bed and pension so that across the family we can invest another 100,000 or so from my general investment account into ISAs or pensions, and therefore securing that future growth is tax-free. So looking specifically at the future ISA contributions, as we know, the investment horizon, or your investment horizon, which is how long you want to hold assets for before you draw on them, it's really important. And I expect not to need to draw from my ISAs for many years, as my living costs will be funded by my general interest account and other savings accounts. So subject to no changes in the ISA allowance, I expect to continue contributing to my ISAs and the family ISAs for at least the next 12 years, meaning I can put in around £240,000 into my ISA, a similar amount can go into my partner's ISA, and a £9,000 each year until my daughter is 18 can go into the junior ISA. So if I extrapolate this using a compound interest calculator, then I should expect to have an ISA pot of close to about 1.6 million for my partner and I, and about £140,000 for my daughter. And that uses a nominal return of around 7.5%. Now, of course, this doesn't take into account inflation, and 7.5% is pretty broad, but I hope that's a reasonable assumption considering overall average stock market returns. Now you might ask why I'm taking money from my general investment account. Well, moving money from a GIA to an ISA or pension is an excellent way of reducing future tax exposure. It allows the growth of those assets to occur without tax implications. Clearly there's CGT exposure when I sell from the general investment account, but over the longer term, the assets, once they've been moved, will grow tax-free in the ISA and only be subject to tax when I withdraw them from the pension after using up the tax-free allowance. So hopefully you found this portfolio update useful. I'd love to hear your thoughts and any questions you've got in the comments below. And if you're enjoying the content, please consider subscribing to the channel, and don't forget to check the links in the description for some great resources and offers on investment platforms. And with that, thank you for watching.